Good morning, everybody. It's Wednesday, July the 29th. Here's what's on the agenda. From luxury to banking, it is a huge day for European earnings, with an uncertain Fed meeting still ahead. Another tough day in Seoul as SK Hynix disappoints, and we wait for big tech to report. Plus, oil's up more than 3% as Iran fires unsuccessfully at US bases, puncturing days of calm. Lizzy.
Well, let's see how that SK Hynix disappointment is weighing on the Kospi this morning. It's already been shut again for 20 minutes earlier in the session, now down 6.7%. That's dragging down Asian stocks more broadly. But we've also got to factor in the latest tensions in the Middle East. So Brent is higher, 3.7% at $87 a barrel this morning, Anna. And yet we have Euro Stoxx futures, 50 futures, not as bad as we're seeing from NASDAQ futures. For the NASDAQ yesterday, it was on the brink of correction territory, but Euro Stoxx 50 futures getting a little bit of boost from all those banks beating estimates this morning. So despite the higher oil price, the countdown to the opening trade starts right now.
Welcome to the programme, everybody. It's 6:58 here in London. A little bit earlier start to the programme than usual because we want to get to our interview with Sergio Ermotti, which we'll do in just a moment, Lizzy. And that explains where Guy is, because he has been speaking to Sergio Ermotti. But let's deal with what we've heard from UBS so far. I mean, better than expected on many metrics. If you're looking at the net profit, pre-tax profit, wealth management, investment banking, the only area that I identified from the headlines earlier where maybe it was a little lighter on pre-tax profit was asset management. But broadly speaking, these numbers coming in ahead of estimates.
Yeah, the wealth business has been, the US wealth business has been UBS's problem child, we should know. But, you know, we've seen good results from Deutsche. We've seen them from Standard Chartered this morning. I was speaking to Bill Winters, the Standard Chartered CEO, just a few minutes ago. It's a high bar when also we've seen such great results out of Wall Street as well. The question is, does it set us up for resilience in the second half of the year?
Yeah, absolutely. And there are added questions about the second half of the year, or where things go later in the year with UBS, because there are questions around the capital structure and how much the government has yet to get involved and further influence the capital structure. This is a process that will go out into 2027. It's all still on the back of the consolidation that we saw in the Swiss banking sector and the demise of Credit Suisse. So Guy Johnson went to speak to Sergio Ermotti, the CEO of UBS, and wanted to get a sense from him about the buyback and whether there was any kind of messaging within the structure of the buyback, because they've gone with this structure that means they've announced a $1 billion buyback over the next 3 months and $3 billion over the next year. And so Guy wanted to understand whether there was any message in here, given the uncertainty about the bank's future capital requirements.
The issue is that what we have is this programs that we have to file with the stock exchange in terms of buyback programs that we can execute in theory over 2 years. And our capital return policy and ambition has been set at the beginning of 2026, when we say that our aim was basically to start with $3 billion and then assess the situation at the end of the first half. So what we do now is we have a new plan, a new program that, and we intend to execute it over the next 12 months. But the pace and size will be determined by our capital position, so staying at 14%, and also the ongoing development in the business, which we are very positive of, but also the ongoing discussion on too big to fail, like we did in the last 2 years. The language hasn't really changed.
The language hasn't really changed, so I shouldn't expect in 3 months' time some clarity on too big to fail.
The billion has to be seen as a minimum commitment that we will do, rather than putting a clear indication on anything more than that.
Equities, very strong. Plus 53%, I think, is the number. That's a nice number. The surprising thing is that you've done it without any extra capital. That's the real standout here. Let me ask you the same question I asked Venkat at Barclays yesterday. If you'd have given that division a bit more extra capital, if you'd have funded it differently, if you'd have provided more for it, could that number have been significantly higher? Are you throttling back equities at the moment? How high could that number be?
Not really. Actually, what we did, the point you raised is a good point, but what we did within the investment bank, we also shifted some capital from the fixed income businesses to the equity business to help them. But our focus is really, which I also believe that the numbers are very strong, because they are mainly driven by intermediation activities. And rather than deploying capital in prime brokerage. But going back to your story, this is more about our strategic capital allocation at group level. We made that decision in 2012 our investment bank fits strategic ambitions that we have to support our wealth management clients, our institutional clients, our corporate clients, but with a defined capital allocation. So we had ups and downs in times in which was very rewarding to have that, and times in which you may have some opportunity cost. But when I look at the full results, a 23% return on allocated capital for the investment bank is pretty strong result. So we are very happy with it.
Okay, but let's the opportunity cost. Let's just talk about the opportunity.
Yeah, but the opportunity cost.
JPM did 86%.
Yeah,
could you have done that kind of number?
Yeah, but is not something. If and when doesn't matter, because I think our philosophy, our capital allocation, and our stock is rewarded by this business mix and not by taking opportunistic and tactical view on momentum in any of our businesses.
Do you think if you were a US bank, you'd do something close to, 86% for JPM, Goldman Sachs did 71%. If you were a US bank, do you think you'd get those kinds?
It's too hypothetical to answer that question.
Well,
we are not a US bank, we are a Swiss bank, and we are very happy with that kind of
you can see where I'm going with that, if you re-domiciled. Is there a cost to being a Swiss bank?
I think there are also a lot of good opportunities, but of course things have to be fully balanced. But I'm very happy with our results and what we achieved as a business mix, right? So if you look at wealth management, you look at the Swiss business, asset management, and the investment bank all together put up a very strong set of results.
That was the UBS CEO Sergio Ermotti speaking to Guy Johnson, of course, talking about a range of topics very pertinent to the broader earnings story, Lizzy, but also the specifics around this particular Swiss bank.
Yeah, well, if we haven't had enough earnings already this morning, more to come. We've got European earnings due after market from Airbus and L'Oreal. Of course, it is also Fed Day, so we've got the decision at 7 p.m. London time, that followed by the press conference from Kevin Walsh, the chairman, and then we get even more earnings tech-wise from Microsoft, Meta and Qualcomm, both all due after market stateside. Now, let's just focus in for a minute on Fed Day, lest we forget that what a consequential event this could be for markets this week. Arguably, it could be the most consequential thing. So many commentators, banks out there saying that it is more than the consensus suggests is plausible, that we actually get a surprise hike from Kevin Walsh. And, speaking to Ben Ram, he's saying this is needed from Walsh for credibility. And so the hike bets have been building, not just for today, also for September. And you've got the futures tied to the Fed's interest rate at all-time highs, because traders really braced for these hikes. So we could get quite a surprising market reaction.
Yeah.
If you look at equities, such a miserable day for the Nasdaq yesterday, you could see even more pressure on the Nasdaq. If you see a surprise hike, you could see a dollar spike. You could see a drop if the Fed holds. This is according to TD. If you get 2 or fewer dissents, so a lot of focus on the Fed later on.
Absolutely, a lot of focus on those dissents. And are we just going to have to get used to a lot more volatility in markets, whatever the Fed decides, because we're going to have a lack of conviction probably going into every Fed meeting, aren't we? Because everyone's going to come up with different arguments based on the data. I mean, if you wanted to hike, then you've got reasons to do it, haven't you? Been above target for a number of years, increased the inflation-fighting credibility of the Fed. Reversing the insurance cuts could be the way that it's thought about by some. If you don't want to, then you can argue that a lot of the higher energy prices are just temporary, tariffs are temporary, and actually the most recent CPI showed a bit of a downdraft, didn't it, for inflation? Is that too backward-looking given the subsequent spike we saw in oil prices?
Yeah.
But, you can argue it either way, and maybe that's exactly how Kevin Walsh wants it to be.
And that was exactly the piece of data that Donald Trump pointed to when he yet again pushed for lower rates.
Yeah, we'll watch if we get any political contribution on that rate story. Let's talk about what else is ahead, and you mentioned it in looking at what is on the trading day ahead there, Lizzy, talking about the tech earnings. We have a number of tech earnings to talk about, but we also, of course, have numbers out of SK Hynix, and that feeds into the back backstory for these hyperscaler earnings. So if we just focus on the SK Hynix numbers for a moment, the company's saying that demand is going to run ahead of supply out to 2030. There's a memory shortage. It's going to persist out beyond 2030. They announced record CapEx plans, which is the thing that makes the market nervous, despite the fact that net profits up by, I don't like using percentages in this context, but I will do, 1,200% net profit is increased. Operating profit up by 550%. So these, on some measures, were incredible numbers, but the market was waiting for something that was incredible plus, and we didn't quite get it. And so the stock itself down considerably, adding up to a second day, a difficult day for the Kospi, down for 2 days. SK Hynix down by 45% just over the past month. And we're waiting for a lot of tech earnings from the United States, which of course ties into the same theme, the AI build-out. Microsoft, Meta, Qualcomm, all set to report later on today.
Yeah, there's a really great superlative from one of our colleagues earlier that this current bout of volatility for Korea is more than the most volatile quarter of most major markets at any point in their history. So you could go back nearly 100 years and we're at that point.
Yeah, absolutely. So certainly a lot of focus on Korea and whether that volatility is warranted, desirable and spreading around the world. Let's talk about that with Anthony Stevens, who joins us now, our colleague in Hong Kong, of course. Anthony, give us your thoughts on the market response to these SK Hynix numbers, because we've seen incredible jumps in profitability, the charts going round and round, operating profit jumping really strongly, look quite incredible, and yet the stock drops. I just wonder if the stock performance is attached to the news flow for SK Hynix anymore. Such is the expectation here.
Yeah, expectations are the key moment. It's not the absolute number. It's what does the market expect. And on the operating profit side, it was a clean miss versus those expectations. And it's important to put those expectations in context. There are 45 buys on this stock and 0 sells. And the debate around the strength of that result and how far that Hynix can hang on to 80% plus margins, that is what is driving the 15% intraday swing in the Kospi today. So there was a very early bump as people, as you correctly said, they focused on how big these numbers are on an absolute basis, how fast the growth is, how strong the pricing power is. But then over the course of the session and into the analyst call, you heard these rather aggressive questions from the Korean domestic broker base in particular about the sustainability of the AI boom and the pricing power maintenance that Hynix will be able to hold. So they were quite defensive about their HBM position. They said that it's a very strong technological moat that should hold into the next couple of years. They're also talking about mass producing their next generation of HBM4E. So there was some positive pushback from the company, but instead the street is functioning on show me the money now, the operating profit that we expected, and further, tell me about your shareholder return program. That was another kind of disappointment to the market. There was nothing announced, and that was put down to the fact that they've just released an ADR and they're kind of constrained on that front. So what's very interesting to see in the next couple of days is how will the street respond to this earnings result. Bear in mind the median street or the average street an analyst rating on this stock is a buy, and the target price is almost double where the stock is right now. So there is some adjustment that is probably going to come from the street, and what does that look like going forward? Now, in terms of the last thing, the elephant in the room, is how much can Chinese competition disrupt this HBM market, disrupt the DRAM market, disrupt the NAND market? And we did see how sensitive Hynix is to those changes in its results, because a slight shift in the product mix caused the OP miss.
So we know that this is a typically volatile stock, but how much should we read into these big moves, Anthony? Should we be worried about AI slowing down, being over, supply chain risks as well?
Yeah, it's a very interesting confluence of flow and fundamentals here, right? The flow, first of all, let's address that. It's massive. Today, for example, in Korea, you're seeing local domestics, buy a couple of $1 billion, again selling from foreigners and individuals. Individuals are very long Hynix, as you guys have been covering, on the leverage ETF front in both the US and in Korea and in Hong Kong. So how much of that cutting has to continue? How much de-risking has to happen for volatility of this size? Because this is a core large position. Core large positions are not supposed to swing 15% intraday. So people have to adjust their position sizing to this volatility, to the first half of your point. In the second half of your point, we continue to be exposed to a very rapidly growing Chinese disruption. And the pace of the Chinese disruption seems to be increasing into the back end of this year as China catches up from the hardware and software side. So what advances will come out of China that kind of look to erode this HBM advantage Korea has, that is going to be a fundamental driver. And it's really interesting to see the street react to this confluence of events. There's a lot of flow notes out there. There's a lot of fundamental technology analysis. But in truth, we are going to move from a binary kind of price action to really detailed focused trading of tech in the back half of the year. We've seen that significant dispersion in the tech trade in the US, and that's coming to Asia probably.
Okay, Anthony, thank you very much. That's Bloomberg's Anthony Stevens on those SK Hynix numbers. But coming up, oil surging as fresh fighting erupts across the Middle East. We'll bring you the latest. Plus, Kering ADRs surging by the biggest intraday rise on record after the luxury goods maker reported better than expected revenue for its Gucci brand. We'll dig into the luxury sector. But up next, more earnings coverage, an exclusive conversation with the ASM International CEO Hichem M'Saad. Now, if you've got any questions of your own for our guests, please do send them to us on IB+BB TV Go. We'll have a go at putting them to our guests. Thank you. This is Bloomberg. Three minutes away from the opening trade, and here is the picture for European futures. Euro Stoxx 50 futures down 0.2%, but we could see bright spots for the FTSE 100 and the CAC 40 in Paris. Of course, we're seeing higher oil prices, so energy could boost the FTSE, but it could drag down the broader sentiment. We've also got to factor in the beats from banks, as we've been discussing, and the broader tech story. Another day of misery for the Kospi. How much is that going to feed into the European stock picture this morning, Anna?
Yeah, let's talk about the earnings picture that we're digesting. ASM International has forecast revenue for the third quarter that beat analyst estimates. The Dutch company says demand for its chip-making equipment is being driven by the global build-out of artificial intelligence infrastructure. Joining us now for his first ever TV interview, I'm very pleased to say that Hichem M'Saad is with us, the CEO of ASM International. Thank you so much, Hichem, for joining us and for coming to speak to us. I noticed that your ADRs, your US listing, the stock was a little weaker on some of the second quarter dynamics that you've reported, but you've upgraded your guidance looking ahead. So I wonder what kind of visibility you have around this updated guidance.
Okay, thank you very much, Anna. And it's my pleasure to have this interview with Bloomberg. As you have seen in our Q2 results, we are very excited about where we stand as a semiconductor equipment company in this AI age. We have a significant increase in our revenue. For the first time, we have actually reached 1 billion in revenue per quarter. We are also very profitable. And most importantly, actually, we've been able to execute in an environment which is really driven by lots of supply chain issue and so on. But also at the same time, we are very confident about the future. And that's why we upgraded our guidance for the second half of 2026 to greater than 20% revenue in the second half versus the first half. Not only that, we've been working with our customers, and we actually also have upgraded our guidance for 2027, where we see very good visibility for us in the future.
Okay, so you have very good visibility into the future, which is interesting. So, I mean, your business then, Hichem, it makes the equipment that makes the advanced logic chips, and the more layers there are on those chips, the more work there is for you and your equipment to do. So what assumptions are you making about layering, about the intensity of that layering into the future? Are we going to see a pickup there, a step change there?
Yeah, I think what's really driving our growth is really the technology is moving into high performance. And high performance right now is being driven more than anything else, is being driven by AI. But also high performance can be driven by mobile devices and high performance computing. But what's happening is to get the high performance, you actually need new materials because you cannot shrink anymore. And the new materials, we are actually a materials discovery company. We are a company that develops and discovers new material to allow you to get the performance that's needed. So we actually at the sweet spot of the semiconductor industry. And the materials that we develop makes the chips faster, makes them run more efficient, using less energy. They make them also have a higher density of storage. And so not only we're working in logic, but also we're working in memory and advanced packaging. So the industry by itself has moved from getting performance through shrinking, from getting performance through new materials, because materials provide you the performance. The other thing that we have seen, that device complexity is becoming more and more important. So as you make things smaller, you cannot. You need to go to 3D. You need to actually, device complexity is moving more and more to the top, because you cannot increase the size of the chip. So as you go to 3D devices, which we see in logic and we see in memory, then complexity of the process becomes an issue. And with the process complexity, you need to have much better precision. And to get the precision, the best technology to do these films are ALD. And we are an ALD leader from that point of view. So we're very excited
Hichem,
that, okay, the industry...
Hichem, Hichem, let me just interrupt you, because it's Lizzy here in London. I want to just come into you and ask about this broader sell-off in chip stocks as well, because it does continue. We've seen misery on the Nasdaq yesterday. We've seen misery on the Kospi this morning. How concerned should investors be about the sustainability of the AI boom? What's your take on all of this?
I think that the semiconductor industry, I've been in the semiconductor industry for the last 32 years. And I've been through many, many cycles since the 1990s. So a semiconductor cycle is the name of the game, and it's something that's very normal. But what's very important is that the fundamentals for AI in the medium and long term are still there. So we're really not concerned from this point of view. And as far as we're concerned, okay, what's happening is that the need for leading edge technology is going to continue unabated for a company like us. It's being driven right now by AI, and it's needed to be driven by AI, but also can be driven, like I mentioned, by mobile devices and high-performance computing. And I think this is something that's normal, that's happening, but actually we're looking into the long term, and the fundamentals are very, very strong for us and for the industry for the future.
Well, just give us more detail then on ASM's exposure to the memory chips market, and really how you see things progressing this year and into 2027.
I think that ASM has been for a long time, like you say, like a logic company. Why? Because we were like an ALD company, and in logic you use lots of ALD. But what changed recently is that also memory needs to have very high performance. And the way to get high performance, actually you need a new material. And the best technology to make new materials is ALD. ALD is the best technology. So we see lots of inroads and equipment sales for our technology in memory right now, because customers need performance and we provide performance for them. So we're starting for a very small base, but we see extremely very significant increase in our interaction with memory customers. We see it with all the memory customers in the world. We see also we have very good visibility because we're working with them on the next generation and so on. And we see them, we see many of our technology in ALD actually being incorporated in their generation, right, like D1C or D1D generation, but also looking for a new transition when the memory is going to move to 4F squared and 3D. You also need more and more of our technology.
Hichem, I wonder how much you're thinking about Chinese competition right now. We've seen in other areas of the Dutch technology landscape concern about that this week. And I wonder how concerned you are about how quickly the Chinese are developing competitive products in the chip equipment manufacturing space.
I think China has been developing products for many, many years, and they have a strategy to actually have localization. For China, what I'm trying to say here is that where we work in China, we work in China in mature technology node. So for the rest of the world, we sell our products in leading edge, but in China, it's really mainly mature technology nodes for both logic and for memory. So that's really the sweet spot of our market. But also we sell in China in the power wafer analog part of the market. And we've been very successful to compete in China against a local supplier. And we had head-to-head competition with some of them. And we see our position actually actually staying very strong because we're providing value to the customer and we're providing innovation. If you see what we do to compete, I mean, it's for us, we have been competing with the big guys everywhere in the world as a small company. So I think we know how to compete, and China is in competition there. Yeah, you just have to innovate, and that's really our DNA. And we see very good acceptance of our technology in China. Okay. And our China business in technology node is actually very strong because of that.
Hichem, thank you so much. Thank you very much for joining us. Come and speak to us again. Hichem M'Saad, the ASM International CEO. Lizzy.
Well, let's take you through what else you need to know this morning. An OpenAI agent that breached systems at the startup Hugging Face earlier this month has also compromised a customer of the technology company Modal. The agent broke into an isolated testing environment known as a sandbox that Modal was running for a customer who had set up a publicly accessible interface. OpenAI declined to comment on the compromise. Elsewhere, Kering ADRs have surged by the biggest intraday rise on record after the luxury goods maker reported better than expected revenue for its Gucci brand in the second quarter. CEO Luca De Meo sees growth for the group this year, but says that it won't be linear and notes that the global geopolitical situation holds challenges. Well, speaking of which, oil has jumped after the US said it intercepted an attack on American military bases in the Middle East. US Central Command also said that US and Saudi forces had carried out strikes on Iran-backed militants in Iraq in response to attempted drone attacks on US forces. The attacks and days of relative calm. Well, coming up, we will bring you more on that conflict in the Middle East. Oil prices really in focus. Where do they go next if the flare-up escalates? That's next. This is Bloomberg.
Welcome back, everybody. This is the opening trade. 30 minutes until we get the opening trade. Let's have a look at the futures picture for European stocks. And we're factoring in a number of themes here. We've got another day of negativity in the Asia tech landscape. That doesn't always translate all that clearly into what's happening here in Europe. And we have a lot of earnings stories to overlay on top. So we're just trying to find our feet, really, on the European equity market picture as a result. In fact, yesterday, we made some decent gains in Western markets as a result of a weaker oil price, largely, and despite the negativity coming through from the Asian tech session. Today looks a little different. Nasdaq futures are pointing down by 0.3%, but E-minis are flat as well. So it seems as if ahead of the Fed, with a lot of earnings reports to factor in, we are waiting for a little bit more guidance and conviction, perhaps. Let's have a look at the bond markets and see where we are there. This is an area where we might expect that higher oil price to be factored in more quickly, and we can see that we do have yields going a little bit higher, and as a result of a 4% jump in oil prices this morning, perhaps we make that link. So 87.45 is where we trade on the Brent price, up by 4%. And so we see a little bit of movement higher in yields, a bit of selling in bond markets. Let's get to the source of that oil market story. Oil is jumping this morning after the latest flare-up in the Middle East brings to an end days of relative calm and casts a shadow over diplomatic efforts to end the conflict. Let's get an update on what's been happening then in the past 24 hours with Abir Abu Omar, Bloomberg Horizons Middle East and Africa anchor. Abir, good morning to you. So bring us up to speed with the latest then, what it is Iran, or what it is the Americans have said Iran has done and what the Iranians say that they've been doing.
Good morning, Anna. So it seems like we saw an unprompted attack by Iran this morning. And when I say unprompted, I just mean that over the past few days, we have seen a sense of calmness, really, in the Middle East. That follows the United States, without explanation, on Friday, halting attacks against Iran after 13 consecutive nights of hitting targets within Iran. So what we saw overnight is Iran attacking military bases, U.S. military bases. Those were all intercepted according to the United States Central Command, but still it looks like Iran had done a preemptive strike of some sorts in the early hours of the morning. We also saw Jordan reporting that 5 missiles by Iran were launched at its territories, and so we're seeing a slight tick up in the escalations in the Middle East, again, as I mentioned, after days of calmness that were in the environment here. And so what we're looking at is the price of crude, as you've mentioned in your intro, at about $87 on the barrel. It was ticking up 4%. It still is, as a matter of fact, 4% higher because of these escalations that we're seeing in the region. Obviously, Anna, at the heart of all of this remains the Strait of Hormuz and the still paralyzed movement there. But we're not just looking at one waterway now, we're looking at 2 waterways, because Ras al-Mandab, Bab al-Mandab, which is in the Red Sea and which Saudi Arabia has been resorting to as an ulterior pathway to get its crude shipments across, is now also at risk, because we're seeing the Yemen Houthis, which are backed by Iran, also attacking it and going for these tit-for-tat strikes there. So across the board, risk on in the region. We continue to obviously monitor what the United States wakes up to and what President Trump decides to do.
And so, Abir, where do we see oil going if the fighting escalates further?
Yeah, it's a good question, Lizzy. I mean, we are anticipating the potential of further escalation in the region. Those tit-for-tat strikes have been happening. And again, just remember that the halting of the attacks by the United States on Friday came without explanation from the U.S. side. We understand from multiple media reports that could have been due to possibly diminishing munition power by the United States. President Trump obviously came out and refuted that, saying that the United States had more than enough munition, that he would love for the United States to have more, but that it has the power to continue fighting Iran. Iran, on the other side, has the ability, Lizzy, to manufacture those drones for quite cheap. And so it has the ability to keep hitting countries in the region. And that is what it has shown. But meanwhile, what we're monitoring very closely and what is impacting that price of Brent and crude generally is those talks between Oman and Iran to open a so-called middle passageway in the Strait of Hormuz, a pathway that has not been used throughout the course of this war because Iran has been asking ships to continue to stick to the northern side of the Strait of Hormuz, close to its borders. So if that were to happen, that potentially gives ships and tankers that are trying to make their way through the Strait of Hormuz a little bit more ability to start making their shipments or having their shipments come across the waterway. Those conversations are not finalized. We're reporting that they're still going on, and we'll continue to monitor whether they actually lead to some kind of conclusion where ships can finally start moving a little bit more freely in the Strait of Hormuz.
Abir, thank you very much. Bloomberg Horizons Middle East and Africa anchor, Abir Abu Omar. Joining us now from a wider perspective on the investment landscape, Ethan Devitt, who's Senior Investment Advisor over at Moneta. Ethan, nice to speak to you. Thank you for joining us here on the opening trade. How do you keep up with the volatility in the oil price? I mean, just in the last 3 months, we've been as high as $120, as low as $72. We spiked up to $100, and now we're back at $87. I mean, and this is an incredibly big range in which we are swinging around. What do you do in that backdrop?
Well, this is really interesting for investors because what it really gets down to is the inflation number, because this is clearly what's driving the inflation number, which in its turn will turn to interest rate expectations, and from there we can look at economic policy. So I'd say when it comes to this is clearly a quite a decentralized and even, should I say, disorganized conflict, in that we have conflicting pieces of information. We know that they're changing. We have one end of the weekend to another, and equally the swings in the oil price, as you noted, have been quite severe. We had oil cross $100 just the end of last week. So clearly investors need to navigate in some way, but focus, I would suggest, on that inflation number.
And with inflation in mind then, I mean, does that lean toward more central bank hiking? We've got the Fed today, we've got the Bank of England this week. Are we looking at more hikes as a result of this push higher in oil prices? not necessarily today's, but broadly speaking, these higher oil prices? Or are we still able to just look through this and say this is geopolitical and temporary?
It does seem that geopolitical forces tend to be somewhat, markets are agnostic towards them. And what it seems is, given the volatility and how quickly this information is changing, the Fed is likely to regard this as a temporary phenomenon. However, it does need to look at the core underlying inflation indicators. Let's not forget, even in June, it did look somewhat seductively low. And that was a suggestion that they could then maybe pause and maybe even still continue with their monetary easing later in the year. So I'd say we're not looking at a hike just yet, given the fractiousness of markets, the uncertainty, the tariffs have injected more uncertainty. And we've also had this weakness in the AI trade. All of those factors, the confluence of them, would suggest this is probably the very wrong time to now shock markets with a rate increase.
Yeah, because we see the AI capex jitters surfacing every day, right? But how do you think about that? You know, the big question, obviously, is it going to burst the AI bubble? But every day we see them, does it push you more towards asking that question?
It would have to push you there. I think when we see someone like a Google Alphabet going into negative cash flow, that has got to make you think that there's going to be a focus on whether there's a bottomless pit here or whether there will have to be trade-offs. We saw that with IBM, there was going to have to be trade-offs. And now we can see that this is clearly not something that's fully sustainable. There will be trade-offs made in terms of corporate spend. And the numbers have been huge. And I think we have been focused on the circularity there. And we'll have to wonder whether that sort of circularity is going to ultimately end in tears.
Yeah.
And that's what investors have been focused on.
And what about all the IPOs? Because it was a massive day for SpaceX yesterday. 20% below the IPO price, but then bouncing back. Do you just kind of treat these IPOs with a huge dollop of caution?
We have to, because look at where the SpaceX funds were coming from. There was a lot of retail involvement. There was a lot of speculative involvement. We saw Bitcoin fall at the same time as SpaceX was the flurry of excitement. So clearly we would think of where is that marginal dollar coming from to invest in SpaceX, probably the more speculative end of the spectrum. We knew even at the IPO stage that there was a lot of hope and expectation, and the Elon trade essentially baked into that. And now we're seeing that much of that did not have grounding in fundamentals. I think what this does suggest, though, is for the rest of the year, where does this place the other IPOs? Will there be much more caution? We've even seen throughout the globe, actually, around Asia, that there has been a lot of excitement day one of an IPO and then a kind of a burning off of that excitement.
XMT, yeah.
Yeah, I mean, is that just the tech? That's something for the tech sector, though. More broadly, are we seeing a return to IPOs that gives us a bit more encouragement, other sectors?
Well, we have seen some broadening. I suppose that's the key thing in markets. Is it all concentrated or has there been that rotation? We have been seeing some broadening, not just into other sectors, but also into small cap. And that is generally a healthy sign. But when it comes to tech IPOs, so much is speculative, so much is uncertain. We've even seen the large hyperscalers discuss that they do not really know how to model revenues given some of this uncertainty. This latest jolt of uncertainty around the Chinese open models injected only this week, we can see just how quickly these cycles are manifesting. Yeah. We have a revenue cycle that shows a vertical wall of demand. And next thing we ask whether token maxing is over and that wall of demand is now going to go elsewhere. So how do you factor that in, particularly to a company that's trying its best, looking at OpenAI and Anthropic, to really pass muster when it comes to the institutional investor and the demands of being a public company?
Yeah, I mean, what do we read into the capex announcements we've had so far from some of the big tech companies then, Ethan, and what we're looking for here? Because it does seem, you mentioned Alphabet, we've had SK Hynix, both of them with big capex numbers, the former with an upgrade to capex, the latter with just a huge capex number. Does that tell us that we don't want to see those big capex numbers anymore? The market is done with that theme, and actually what we want to see now is restraint.
What we would say is we need to see some clarity and we need to see some realism in terms of these numbers, not simply kind of buying into this, the hype trade and the sense that there will be on a hockey stick trajectory of demand that's never going to be faced with external forces like we're seeing with the OpenAI, the Chinese trade, as well as the potential for consumers to trade down and no longer continue with their use of tokens as they are, be a bit more price sensitive. So we need the capex numbers to reflect that there is uncertainty baked into that. Investors appreciate a certain sense of honesty when it comes to capex and projections, and a sense that there is being anchored in reality and not simply buying the last hype cycle.
Ethan, you've tagged tariffs as something to watch. Are we underestimating the impact of tariffs as President Trump rebuilds the tariff wall? Because we've seen them before. Are we not giving enough emphasis to them now that we see them again?
Well, there's a lot of pattern recognition this summer, a lot of deja vu, not only in the Strait of Hormuz, not only around technology and its kind of bangs and whimpers, but also around this tariff story. I'd say there are a few fundamentally different things today. First of all, there's already been a court challenge. There has been kind of a cycle through that sense of scrutiny, and the current tariffs have been drafted in such a way that they will probably withstand legal challenge going forward. So they could be here to stay. The second thing is that we still don't know how tariffs translate into inflation. There was not the transmission effect that was instant. There was a much more sense of complexity. Some companies may have had inventories they could have relied on. They may not have had the power to pass pricing through. So the sense that tariffs don't cause inflation, that causal link was perhaps too easily drawn and is not quite accurate. So I'd say we're going to see something different this time around.
Ethan, how would you characterise globalisation right now? Is globalisation over? Have we just seen peak globalisation, but it's still very much a force? How are you thinking about that as a concept, and that maybe influences investment strategy?
I think the binary on globalization, slowbalization, deglobalization is a little bit too simplistic that some of the leaders and even corporate leaders could be guilty of suggesting. I believe globalization, that ship has sailed in the sense that it is too far gone to reverse. Just as an example, Moneta, we've just opened our London office. We see the potential to be a global wealth provider. That is not changing anytime soon. Increasingly, individuals lead global lives. Those are complex lives. We see companies dependent on supply chains. We know from COVID and the Strait of Hormuz and the Russia-Ukraine crisis, being dependent on one concentrated supplier is a bad thing. But you need to seek the lowest source provider. And clearly, tariffs are upsetting this apple cart in terms of the globalization we're seeing. But there will be, just as Mark Carney said at Davos, there will be a sense of the middle powers having to forge their own path and find a different pathway. So globalization is here. As I said, that ship has sailed. Maybe it will slow down. Maybe there will be hiccups. There will be alliances drawn in different ways.
OK, Ethan, thank you very much. Thanks for coming to speak to us. Ethan Devitt, Senior Investment Advisor at Moneta. Now, corporate leaders have been weighing in on the impact of the Iran conflict on their businesses.
In terms of the impact on our business, there has been disruptions out of the Middle East. Some of that is temporary. Some of that will take a little bit longer to return. But we make our supply projections on long term. There'll be fluctuations in the short term as some of those disruptions are worked through. But in the longer term, aluminium's going to be well supported.
That was the Rio Tinto CEO Simon Trott speaking exclusively to Bloomberg after the company posted a jump in profit for the first half on the back of strong commodity prices. More earnings coverage coming up. This is Buyback. Welcome back. Let's have a look at the picture across the European futures right now. And we're pretty flat, actually. But, Lizzy, as we've been saying over the last couple of days, this doesn't really do justice to the news flow, does it? We've had so many corporates reporting from the luxury space to the banking space. We could see some fairly substantial moves, certainly in luxury, at the start of the trading day. But for what it's worth, the overall market picture looks fairly sluggish as we factor in earnings, but also a higher oil price this morning.
How very deceptive. Let's turn now to our markets in 3 minutes on the opening trade with Markets Live Executive Editor Mark Cudmore. Mark, good morning. I want to start closest to where you are in Korea. We've seen huge moves on the Kospi again today. Are you surprised that we're once again seeing trading halted earlier on in the session after that SK Hynix disappointment? What do you read into it for the broader move in mood in markets when it comes to tech?
The volatility in Korea has been absolutely insane. This was supposedly a major serious market. Only in June, this was a market worth over $5 trillion. This isn't, meant to be some kind of penny asset class. But it's having volatility like it did at the end of the last century in the Asia crisis when it was only a $500 billion market. So, this is just insane amount of volatility. We've seen about $1.7 trillion wiped out of that stock market over the last 5 weeks in really, really kind of crazy moves. What are my big takeaways? The price action away from Korea is incredibly strong, incredibly resilient. Sure, we've seen chip stock weakness over the last 10 days, but in context of where it's come this year, stock markets are doing very well. The S&P 500 is less than 2.5%
4.5% off its record highs. Overall, we are seeing resilience in stock markets. That's very impressive. Now, I do think that the level of volatility that we've seen in Korea, we're closing today below the 200-day moving average, and the scale of volatility going into the Fed meeting, going into the US-Iran kind of event risk, means that we're going to see deleveraging probably pressures into the weekend, higher kind of value at risk measures, which is going to put pressure. But that said, it's all going to depend on the Fed and the US-Iran deal. So we've got two very binary risks. And I think my biggest call right now is that we've had extraordinarily low correlation across major stock markets over the last couple of months. It's probably been the biggest themes of this year. You've seen Korea bubble pop and yet not the AI bubble pop elsewhere. My theory is that into month end of the next 3 days, depending whatever the Fed does, whichever direction it kind of moves markets, that we'll see a recorrelation. We'll either see everything rise together into the last few days or we'll see everything fall together.
Yeah, that correlation trend, Mark, I mean, it is low by historic standards, as you point out, looking at a sort of long-term perspective. But it more recently does just seem to be moving around with the oil price. So when we see jumps in the oil price, things are more correlated. Is that what we're seeing at the moment?
That's absolutely right, Anna. So we've seen a pickup over the past week, but again, a pickup from rock bottom levels, and it's still super low. I think that, the US-Iran situation is still massive. I mean, it was funny today. We were observing internally when oil was only up 4.5%. Someone said, I can't believe how calm oil prices are given the headlines. And I thought it hilarious that 4.5% is now considered a calm day in oil. But that's kind of true at the moment. So I think that is one major event risk. And, many people have talked about, we haven't had a Fed that's kind of been so uncertain on the day of the meeting for, probably 20 years or thereabouts. And therefore, there's no alpha to kind of make a prediction on that meeting in advance. You've got to play the decision. So I think that between the Fed decision and oil price into the weekend, they're a major catalyst. They could go either way. And I think you just got to play the kind of the results in that. But my point is that we'll probably see more markets move together rather than relative value, because relative value pods have blown up in the last couple of days.
Mark, nice to see you. That's our Bloomberg Markets Live Executive Editor, Mark Cudmore. And remember, you can get up-to-date analysis and insight from Mark and the team by going to MLIV Go on your terminal.
Let's get a look at the stocks to watch this morning. Bloomberg's Alex Morgan has a rundown. I don't know how you've chosen, Alex. There's just so many to choose from. So you start. We'll fill in the gaps.
Do you know, it's one of those days, isn't it, where, you're spoiled for choice. But let's kick it off with UBS. It's a strong morning for European banking. Of course, you've been talking about this on the programme. UBS beating estimates, but there's, of course, that $3 billion buyback announced today after the completion of the last one. That'll run until the second quarter next year. But what is interesting about these earnings this morning is it also comes with a 28-page document with UBS talking about the Swiss capital debate. Now, that's a bit broad for us to get into here, but that is the political debate going on in Switzerland, working its way through the system at the moment. 28 pages of that with the earnings this morning. But UBS announcing that $3 billion buyback. We'll be keeping our eyes on them this morning. Let's turn it over to Deutsche Bank. And that was a record second quarter for fixed income trading. And what is interesting here is that was beating estimates, but also beating the average for Wall Street. And, of course, we've seen a real bumper time over there. So eyes also on Deutsche Bank. Let's switch it away from banking for a moment to look at luxury. And, of course, there's a lot of names we've been talking about this week, starting with LVMH. Hermes as well got their earnings out this morning. But I want to zoom in on Kering if we can. And you can see, the story here has been about attempting to turn around that luxury house. The main brand there is Gucci. And we've seen the earnings coming out after hours yesterday. But the emphasis was that Gucci is recovering under the new CEO. There's been a cut to headcount, a closure of less profitable stores, and analysts sort of picking up on that recovery in these figures. Edouard Aubin saying overall this is a better set of numbers at the top and the bottom end than people were expecting. So this morning, keep your eyes on Kering, but also on Hermes, as I said, as well, who have earnings out today as well.
Alex, thank you very much. Bloomberg's Alex Morgan. Kicking us off with some of the stocks we're watching. Let's add to the list then, Lizzy. Also watching Rio Tinto, an emphasis there on cost cutting. We heard from the CEO earlier. You spoke to Standard Chartered, a better than expected picture coming through in the numbers there. Electrolux, that's often really volatile, and that could be a big mover at the start of trade. BASF, also a buyback there and better than expected numbers.
Yeah, we spoke to ASM earlier in the programme as well. Their outlook beating estimates, so many to choose from. I also just think that China theme that Alex was touching on when it comes to to Kering. Really interesting. It cuts across so many sectors. But one of the lines that stuck out to me from Luca Di Maio yesterday was just saying that China's an upside if you do it right.
Right.
Not
yes.
what we heard from other luxury names.
Right.
And
Hermès talking about how China is stabilising, but there's no fundamental rebound. So there's a lot of different dynamics happening, it seems, on China luxury. We'll get into that later in the programme. Coming up on the opening trade, we'll bring you the market open. This is Bloomberg. Welcome back to the opening trade, everybody. We've got a lot of earnings to focus on and to price in this morning here in Europe. But let's take a short trip down memory lane to remind ourselves of the session of yesterday on Wall Street and what that might mean for the session ahead here in Europe. Well, you can see we factored in quite a lot of the upside. And after Europe closed, we kind of trod water in the US session. But we didn't make bad progress on European stocks yesterday, despite the fact we saw on US stocks yesterday, despite the fact we saw chip stocks were under pressure in the US. And that continues very much to be a theme over in Asia. It seems that Europe is managing to put that to one side, and to some degree we saw the US markets putting that to one side, and overall not succumbing too much to the downside. Well, today looks like another day where we don't succumb to the downside around the AI theme. Instead, we focus on some of the earnings. We're also factoring in a higher oil price, and that could be something that we watch, certainly in the London market. We are expected to go a little bit higher, up by around 0.25% in London. DAX futures flat to negative. Euro Stoxx futures as a whole then, Lizzy, looking pretty range-bound, and US futures pretty flat this morning.
Well, Anna, as you say, it could be that we see some of those bank earnings beats offsetting the impact of higher oil prices this morning. Euro Stoxx 50 futures are higher. Let's dive into the banks. We've had Deutsche Bank's traders seeing 16% revenue rise to beat Wall Street. UBS and Standard Chartered with announcements on buybacks. So that's the banks. Then we've got tech in focus as well, because the questions about AI capex renewed by the response to the SK Hynix numbers. And then luxury in focus. Alex Morgan flagged for us the Kering results, signs of progress, reviving sales at Gucci. Does this boost the sector more broadly at the open this morning, Anna?
Yeah, absolutely. So all of those sectors very much in focus, and might we see some fairly substantial movement in individual stocks, even if the top line story on these markets doesn't tell us anything particularly exciting. But we have so many earnings stories to factor in here that could result in some single stock volatility. Let's have a look at where we are at the start of the trading day then. This Wednesday morning, the FTSE 100 first out of the gates, up by 0.2%. Sadly, we have returned to kinetic activity in the Middle East. We've seen Iran launching attacks that failed to make contact, it would seem, with US bases in the region. That's pushed oil prices higher. That gives London perhaps another leg up in terms of the energy names. We'll watch if that is in the driving seat, or whether it's further rotation away from tech themes that is boosting some of the FTSE names. The Stock 600 as a whole then up by around 0.1%. The AEX up 0.1%. The IBEX pretty flat. Of course, we're waiting for the Fed and the Fed rate decision a little bit later on today, Lizzy, which has a lot of uncertainty attached to it. But in the meantime, digesting these earnings stories and not moving very far at the overall index level. What do you see then on the sectors?
Well, if we break it down, we've got about 3/4 in positive territory this morning, and basic resources and energy, as expected, leading the gains this morning. So basic resources up 1.5%, energy up 1.3%. As you say, we have got a higher oil price this morning off the back of the latest in the Middle East. Brent up 3.6% at $87 a barrel. So surprise, surprise, that is boosting the FTSE. Outsized gains of 0.4%, and energy near the top of the leaderboard. Tech, as we would have expected, at the bottom of the basket, down 0.7% this morning, off the back of the broader sentiment that we've already seen in the Asian session, the Kospi down, that spreading more broadly, and Nasdaq futures back in the red as well, down 0.1%. Now, if we look at some of those individual names that we had been flagging, Standard Chartered off the back of their results, Bill Winters will be pleased with this, up more than 2%. UBS up 1.7%, waiting for Deutsche Bank to open. But ASM International, right, down more than 5.5% as things stand. We were speaking to their boss earlier, their outlook beating estimates, and yet those shares in the red at the moment, Anna.
Yeah, it did seem as if the ADRs were a little weaker after those numbers dropped last night over in the United States, and there did seem to be some concern around the second quarter, despite the very positive story that they're telling and the upgrade that we got to the sort of forward-looking numbers. Interesting on the individual names then, EssilorLuxottica moves higher, Glencore moves higher, Process, BASF BASF, we had numbers out of BASF a little earlier on. Hermes is one of the big fallers then this morning. And we had numbers out of Hermes, didn't we? And their conversation around China a little more nuanced, perhaps, than the one that we got from Gucci. ASML down by 1.9%. GSK, numbers through from GSK yesterday, and that stock is just on the back foot this morning.
Well, let's get some analysis now. We can speak to Marina Zavolok, who is Chief European Equity Strategist over at Morgan Stanley. She joins us around the desk now. Marina, great to have you back. I want to start there with this China theme because it's touched luxury across the board, from Mercedes to Kering on the upside. What do you make of it? Are we at an inflection point?
No, it doesn't. I mean, that's what luxury results are telling you. China continues to be a drag, whether it's through competition or through direct exposure and lack of, a meaningful consumer recovery. I think stabilization in the China consumer, which some of the luxury names are pointing to, is not enough to drive a V-shaped recovery. It's not enough to sustain the multiples that we still have in the luxury sector.
But is it how you play it? We're waiting for Kering shares to open, but Luca De Meo yesterday saying that it's the upside. There is an upside there if you do it right.
Yes. So interestingly, we've been underweight luxury in our model, and it's been at the bottom of our model for years now. But what's happened in the last, let's say, 9 months or so is that we used to have all of the luxury stocks in the bottom of our screens. Now there's much more dispersion in the sector. So I agree with you. There's some heavyweights in that sector that are still dragging down the sector overall. And then you have some idiosyncratic story, be it new designers, new kind of lines.
Erling Haaland carrying a handbag.
Yeah.
It's all a bit unpredictable on that front.
And you have strength elsewhere. So the US is helping.
And so if we take a step back from the luxury space, we've got Kering open now. It's up by 9%. So just to sort of tie a bow around that conversation, there we are. Kering is benefiting where Hermes is maybe not this morning. So that's the luxury story. If we take a step back, though, Marina, going into this earnings season, you were quite constructive. Targets have been increasing. How do you feel now we're getting into it properly?
This is a great earnings season for Europe. It's also good for the US, but I haven't seen such a strong earnings season in Europe in years. Earnings revisions breadth has shot up to the high teens. So the net percent of analysts upgrading their numbers is very high. It's higher than the US now. If you look at earnings revisions by sector, almost every sector is now in the green, by the way, including luxury, which is unusual. And we have earnings growth consensus for this year. I think some people drop off their chair when they hear this, but it's 17%. Europe normally does 0 or 1%. We're doing 17% growth this year. Yeah. So we're seeing more interest in European equities, in part because of the strong earnings season that we're seeing.
And so is there one factor driving the strength? That's incredibly broad, isn't it, that statistic?
Yeah,
or is it all
it's a combination of factors. I would break it down into a few, so 3 main ones. So number one, AI. We do have some AI. I know that there's been a sell-off recently, but it is still driving earnings strength in Europe. And I think Europe was kind of lagging that earnings strength in the US, and now it's coming through. So AI is the top of earnings revisions breadth still. You have the banks, which are coming through very strong, higher yields, steeper curves, higher oil prices. This all helps the banks as long as we stay out of a recession. So banks are very strong. And then, to your point, there's broadening. So it's happening across sectors. And one stat I've been pointing out a lot is that Europe actually benefits from inflation as long as we're not in a recession, because 60% of our earnings pie is real assets, banks, compute, all areas that benefit from inflation. So we're seeing that rise the tide.
Yes, if you've got the pricing power to deal with the inflation, then yeah.
Okay, so a really fine line to tread there, really, if you're trying to get between inflation and recession risks. Just on the AI theme, though, how do you play it more specifically?
Well, it's all kind of acting as if it's one trade right now, globally, the AI trade. We still like European semis. We still like some of the larger cap goods, which are very AI heavy. We're overweight. Obviously, it's been painful recently. But one thing I would say is that we typically get poor seasonality and momentum in the summer. This is unusual, this level of seasonality. The last time we saw this was 2022, this unwind in top momentum and rally in the bottom momentum. But typically in August, we start to come through that. So I am hopeful that you start to see a recovery in the AI trade in August, and we would play that through European semis and cap goods.
And how are you positioning around the war uncertainty?
I mean, we expect this to be, let's call it a volatile de-escalation. And we expect oil to come back down to around the $75 level ultimately, but not in a straight line. It's going to be choppy. And for Europe, actually, if oil stays in the 70 to 100 range, that's out of recession territory, but that's still driving moderate inflation. That's actually the sweet spot for European equities. And I've been saying that since the Iran escalation began. And that's what we're seeing in earnings right now.
And we're seeing that in the earnings story. Sticking with other sectors that I think you like, or at least you did like in June, it'd be good to get your updated view, Marina. The banking sector, the mining sector, where do you see most, where are things mispriced and the opportunities the biggest, do you think?
Yeah, the banking sector we still like. That's a steady grind higher. You have kind of almost like a profit bonanza at these level of yields. Again, as long as this AI unwind doesn't broaden to other sectors. And then we're starting to see flows coming back into Europe. And the banks, when we start to see these flows come back on the broadening, banks are typically the number one beneficiary of those flows. But then beyond the banks, we're overweight mining, we're overweight utilities, telecoms. But we published a piece a few weeks ago where we made the point that the market is so idiosyncratic, and it's almost better to choose those few luxury names that actually have idiosyncratic drivers, those few staple names that have idiosyncratic drivers. And that's what we're seeing is a lot of interest in diversifying across all sectors and the best stock within sectors.
What do you think that diversification rotation story looks like, or breadth story looks like into the second half of the year then, Marina? Is Europe's to play for? Is this something that Europe can really benefit from?
I think this is partly seasonal and tactical. I mean, we've been calling for diversification. At this point, if we look at breadth, we are on a 3-month measure. We're halfway back to the peak. So we started around the time the MOU was signed and before this tech sell-off began. We started at historical low levels of breadth in the market. Now I just heard you say 75% of stocks are outperforming today. So breadth is very high. I think when we get to that peak of breadth, we're halfway there, then we start to see a narrowing again in the market. Okay. That's typically what happens.
Marina, thank you very much. Thanks for joining us. Marina Zavalock, Morgan Stanley Chief European Equity Strategist. Let's dive into a few core names that we keep across here in Europe. We've got ASML down by 0.8%. That's the technology thing, which is an area of weakness this morning, along with Schneider Electric. Sometimes they are linked. Nestle up 0.5%. LVMH getting a boost, perhaps from Kering, not being dragged down by Hermes, and that stock is up by just shy of 3%. That seems to be the biggest mover amongst the core six. Let's get to some of the other individual stocks that are on the move this morning. Alex Morgan has a breakdown. Alex.
Well, I would, I'm loath to talk about luxury in the company of the two of you, even though you know so much more about it. But I'm going to start with Kering. That's because they really are leading the pack this morning. Out of the gate, up now, you can see 11% this morning. And yes, that is on the earnings, pointing to a recovery for Gucci. Still not the full story that they want to get to. Of course, as part of the turnaround plan, there is also Yves Saint Laurent in there, but it is Gucci that makes up more than half of Kering's profits. And the turnaround there, you can see, really being warmly welcomed by the market this morning. We got a sense that might be coming from a trade gate earlier, but here we are now, up around 11% this morning. Let's turn it over to tech, though. Different picture. Now, this is, as you were saying earlier, that read across from Asia, the SK Hynix disappointment. You can see the companies touched in Europe in the semiconductor space down. And there's also that broader concern that you're talking about day in, day out about the worries about circular funding, the AI model. So you can see a read across from Asia to European chip makers and those involved in the European chip sector. Let's flip it over to Danone. To miners. Let's get to miners here. Rio Tinto and Glencore both in the green this morning. Of course, talking about commodity prices. A part of that, you can see Rio Tinto up around 2%, Glencore around 4%. Now let's get to Danone as well. Have a look at how they are doing. Down around 3%. Some earnings are also out this morning. ENI, though, in other news, on the back of talking up a share buyback scheme. We're seeing them around 5% in the green this morning. But really the big name that we're talking about is Kering, up more than 10%. And that's coming off the back of those warm words about Gucci's recovery.
All right, Alex, thank you very much. That's Bloomberg's Alex Morgan. And coming up, we will get back to the banking story, earnings out of that as well. UBS rising on the back of a strong quarter as wealth management assets beat estimates and trading revenue surged. Stay with us for that. This is Bloomberg.
Look, if I look at the macro picture, the geopolitical picture, the ongoing debates, also the big dispersion we see in equity markets, and the pressures and on energy prices creates potential headwinds on inflation, and that may turn down to be something that investors will not really like, and creating potential volatility. So I do expect spikes of volatility to continue for the rest of the year.
The UBS CEO Sergio Ermotti speaking there to Guy Johnson, of course, a little bit earlier. UBS shares then this morning, we'll put those up on the screen. You can see the response in the market up by 2.4%. The bank has announced a new $3 billion share buyback program to run until mid next year, and has posted net income of $2.8 billion for the second quarter, beating expectations. In fact, beating expectations on lots of metrics this morning. Let's get to Guy, who is in Zurich after that interview with Sergio Ermotti. So lots of numbers beating expectations. We haven't talked as much about the equities performance on this particular stock than maybe we did around Wall Street banks and others earlier on this week, Guy. So what's the equity story? How responsible is that for the beat?
It's huge. With all these banks, the equity performance has been very, very strong. We saw it yesterday with Barclays. Today, you're getting it with UBS. But how do these European banks stack up against their US peers, I think, is a really interesting question. I think there is also a question around how heavily UBS is leaning on its equity business to sort of produce the kind of performance it's seeing at the moment. I think you probably look at the market reaction this morning and say, actually, there's not much in that argument. But some analysts are certainly pointing at the fact that equities did such heavy lifting here that it maybe affects the quality of the earnings. But European banks generally have underperformed their US peers. And why is that? Why is the number from UBS at 53% plus is really strong, but Wall Street did even better. So I talked to Sergio about this. Is it a capital issue? He says, no, actually, it's not a capital issue, because what we're seeing here is actually a sort of transactional story. It's about the volatility spikes he was just talking about. The volatility is a big driver of this. It's not about kind of providing more capital for this business. They gave it a little bit more capital, and maybe that sort of produced a better performance coming through here. But are European banks, are Swiss banks underperforming their US peers because of the lack of capital? Is there a cost to being a European bank? In particular, for UBS's case, is there a cost to being a Swiss bank? Now, that was a question I asked him, and he said firmly no. He said, he used the language, I'm very happy being a Swiss bank. We are very happy being a Swiss bank. And that's really important in the context of what is happening with the capital rules right now. Maybe a slightly friendlier tone coming through from Sergio Ermotti when it comes to those capital rules. So I think, yes, equity markets have been, the equity division's done really well here. Hasn't quite done as well as Wall Street, but there's a reason for that. And that is that this is a bank that is designed to serve its clients, not to be a trading platform. And that is maybe the reason. That's the opportunity cost that you have being a Swiss bank and being a big wealth manager. And that's the kind of the story that comes out here. And I think the market's responding quite well to that.
Yeah, the shares up nonetheless 2.3%. Guy, thank you for bringing us that interview. In Zurich, that's Bloomberg's Guy Johnson. Well, as he says, we've also had results out of Standard Chartered and Deutsche Bank this morning, both in the green. Standard Chartered announcing a $1 billion share buyback after its second quarter earnings beat expectations. I've been speaking to the CEO, Bill Winters, earlier on, and he told me that they're investing in growth.
We're protected against whatever pullback or surprise may come, but we are investing fully in the business. So, $1 billion buyback, but we're investing, well over $2 billion of cash into our business year after year after year and growing. So, first and foremost, we invest in growth.
Yeah.
We take the surplus and return it to shareholders.
Well, Bloomberg's Charlie Wells is with us to walk us through all of this, give us some more context. Charlie, how would you frame it all? It seems like good, better, best when it comes to European banks.
That's exactly right, Lizzie. So it's beats and buybacks that really have been the theme of the day. And I think the question really had been, what would this do to bank share prices? Because we saw similar results yesterday, and that actually did not bode well for the banks. But we're seeing a lot of green across the board today. What we're seeing here with Standard Chartered is the shares up well over 3% this morning. They had a really strong earnings report. I want to bring that up and talk about some of the key findings from that earnings report for Standard Chartered. They've got that $1 billion share buyback that we've been talking about. Of course, they had that beat, but we also saw a lot of strength coming from their wealth unit. Now, this was really important for Standard Chartered because there had been a lot of concern about Chinese authorities trying to limit the outflow of money from mainland China to places like Hong Kong. And we know Standard Chartered has a lot of exposure to Hong Kong. Let's bring up how Standard Chartered has been performing, because recently they've been hitting record highs. But I want to just show you why that wealth unit was so important. Look at that dip right there. Look at that dip in June. That is investor concern about what could happen on the back of that attempt to limit the outflow of money from China. So what we're seeing is a really solid recovery here, and we're seeing that wealth unit at Standard Chartered help to propel this bank forward. So that should be positive for Standard Chartered. Another big bank in Europe, that's Deutsche Bank. Let's bring up how they're performing this morning, because they have been in the green, and they certainly still are up well over 5% this morning. So again, a strong showing on the back of these earnings. I want to bring up some of those key findings as well to explain some of this movement, some of the investor confidence in Deutsche Bank this morning. What really stood out here was fixed income trading, right? So we've seen across Europe a little bit of a mixed picture, some weakness in FIC at a number of these units, but actually what we saw from Deutsche Bank was outperformance. They were up in the quarter year over year 16%. Now that beat the average from Wall Street competitors who are up on average about 13%. So that's really important for Deutsche Bank. Why that's important? They don't have that equities trading exposure, backed out of that in 2019. So FIC is really crucial for Deutsche Bank, and they really outperformed there. Also buyback. We've been talking a lot about buybacks. They've got that 500 million euro buyback, and then they also confirmed their revenue outlook. Now, this is really important for Deutsche Bank because they've had a huge valuation gap compared to a lot of other European lenders. Look at this gap. That white is other major banks in Europe. That orange is Deutsche Bank. So Christian Sewig really trying to close that gap. These results should help.
Charlie, thanks very much. Charlie Wells with a breakdown of the banking sector reporting season. Let's get to luxury then, where Kering shares are surging this morning. This after the luxury company reported that sales at Gucci came in better than expected in the second quarter. The move is sparking optimism that a long-awaited turnaround at Kering's largest brand is starting to take shape. Let's get into the detail here with Bloomberg opinion columnist Andrea Felsted. Let's start with Kering because we've had other numbers. Good morning, Andrea. I mean, this is fascinating, isn't it? That big pop higher in the share price on the back of Gucci revenue that didn't turn positive year on year. It was better than expected, and it's more in line with the pack, more in line with what others are doing.
That's right. I mean, Gucci's been really struggling, and it looks like it's going in the right direction. It's not growing yet, but it's less bad than it was, and it's less bad than it's expected. So the market's taken that as a sign that perhaps the Gucci turnaround, which is so crucial to Kering, is working.
I don't get it. Is it Demna? I mean, look at the fate of Hermes, right? Weathering the downturn in demand better than its peers, but you would expect Hermes, its shares are down, right? What about the Haaland effect that you've been writing about?
I know. I think Hermes has really got a boost from all these footballers carrying these big Hermes bags, because there was a sense that particularly the Kelly and the Birkin has got a bit overexposed. There were lots of them around on resale sites, and they'd really kind of lost a bit of their cachet. And I think the footballers all carrying the Hermes bags has kind of helped their brand value. I got some data, and it showed that actually Erling Haaland carrying the Birkin and the Hack, which isn't a Birkin but it's like a Birkin, has actually added $8.8 million to their brand value.
Carrying all sorts of things in that photo. It's pretty weird stuff. But lingering on Hermes and the China effect, I suppose, more broadly, they've said some nuanced things about China. I wonder if that's where they come unstuck, because they said they see stabilisation in China, but no fundamental rebound. And I mean, that for a lot of these companies has been a big headwind. We're going to talk to an economist, actually, a little bit later on in the programme. The Chinese consumer is just sitting back.
Exactly. That's been the picture for all of the brands. They've all said, China's sort of stable. We're not seeing the big upswing. Now, what's happened is the US and to some extent South Korea has really made up for that stability, because the wealth effect from AI, roaring stock markets, that's
you see that in luxury sales in South Korea, do you?
Absolutely, right. Yes, and Japan to some extent as well. But I mean, particularly in the US, US demand tends to be correlated with stock markets. So the stock market's been doing so well till recently, at least, that they've been spending. Now, the big worry is the sort of some of the sell-offs we've seen. If that spreads, that equity market story isn't as strong, then that could be a real break on spending. And you've got China not coming back yet, so that's really the worry.
That's really interesting. I want to hear more some of the time about the difference in taste between Koreans, Chinese and Japanese within the Asian market. But for now, Andrea, great to have you back. Bloomberg opinion columnist Andrea Felsted on the latest in the luxury sector. Coming up, though, we are going to turn to the Fed. It is Fed Day, lest you forget, given all these earnings, but a lack of clarity from Fed Chair Kevin Warsh on the future path for rates, really keeping investors on edge. And we're going to discuss today's US rate decision with the HSBC Global Chief Economist, Janet Henry. She'll be with us next. This is Bloomberg.
This is the opening trade. It's Wednesday morning. We're 30 minutes into Wednesday's session here for European stocks. And we're factoring in a lot of corporate earnings, and some of them are really positive. We're seeing some outperformance in some of the luxury names, even consumer white goods, those kind of businesses. We've got some really interesting upside stories. But this is the overall picture before Lizzy gets to some of that detail. So the Stocks Europe 600 up by 0.2% as we factor in the earnings. Also factoring in a higher oil price. Sadly, a return to some violence in the Middle East over the past 24 hours. That means the oil price is up by around 3-4% this morning. The FTSE 100 benefiting from that as we see some of the oil majors moving a little bit higher. And we do see broadly FTSE outperformance this morning. The DAX up by 0.2%. That's the broad picture then, Lizzy, across these European equity markets as we wait for the Fed. That still lies ahead for us. And we wait for big tech earnings. That's going to be really interesting for markets. After SK Hynix, we move on to some of the other big names over in the US. But what have you got in the European session?
Well, Anna, you can tell that it's a busy day for earnings because the balance of Stock 600 members is to the downside, 310 in the red. But as you say, at the headline level, the Stock 600 is up today. Volumes higher as well, up 21%. So let's take a look at some of those individual movers that are distorting the picture, perhaps. So Kering up more than 10%. We were just discussing with Alex Morgan. We've had Gucci's better than expected sales, sending those shares higher. A margin beat also for EssilorLuxottica. Of course, we've seen the combination with Ray-Ban when it comes with other brands when it comes to their smart glasses, and UBS shares out alongside a raft of other banks this morning, Deutsche and Stanchart, but announcing a buyback plan, as did Stanchart, as that investment bank division has surged, so up 2.7% for UBS. But here are the laggards this morning. We've talked about the broader tech theme, results from ASM International, and shares falling 7.8% despite those results. Logitech sliding as well, nearly 6%, a supplier incident hitting sales, and Hermes in the luxury space, the opposite to the Kering story, down 3.4%, Hannah.
So luxury moving in two different directions. Let's step away from the earnings stories for a moment and get an update on some of the other stories that we are following this morning. Oil has jumped after the US said it intercepted an attack on American military bases in the Middle East. US Central Command also said US and Saudi forces had carried out strikes on Iran-backed militants in Iraq in response to attempted drone attacks on US forces. The attacks end days of relative calm and cast a shadow over diplomatic efforts to end the conflict. SK Hynix has earmarked earmarked at least $31 billion in capital expenditure this year after reporting a six-fold surge in quarterly profit, a record outlay that coincides with growing fears about overinvestment in AI capacity. And the Federal Reserve is out with its latest policy decision later today. It is Fed Day. The central bank is expected to keep interest rates on hold when it concludes its two-day meeting. But market participants are eyeing the possibility of a surprise hike as patience with high inflation wears thin. A lot of anticipation then ahead of a pretty uncertain Fed today, Lizzy.
Yeah, which is perhaps the point when you take away so much of the forward guidance. Let's get another view on the Fed today. Janet Henry, Chief Global Economist over at HSBC, joins us round the desk. Janet, great to have you back. What's your view? Are we going to have a surprise hike from the Fed today? Does it need to have a surprise hike for credibility purposes?
Good morning. No. It's the short answer. I would very much doubt we get a surprise hike. I mean, the market's got about a 30% probability of a rate rise. If anything, I think the likelihood of a rate rise is less than 30%. We don't get forward guidance. We'll get a lot of words in the press conference. I'm sure it'll be another frustrating one for all the journalists asking the new Fed chair the various questions, but I think it's extremely unlikely.
But why is it unlikely when we've had oil topping $100 a barrel? Tensions in the Middle East just seem to flare up again and again and again, even if there's this kind of sense of inevitability that things will die down ahead of the midterms. Again, we're reminded that they haven't yet.
I'm not saying necessarily what they should do. I'm saying what I think they will do. And I think Walsh was quite clear at the last press conference. Obviously, he made it clear there's going to be no forward guidance. The committee are split. Half of them said there was a likelihood of a rate rise by the end of the year. Half of them had rates basically on hold. But you've got to remember, a lot of those members of the FOMC, earlier in the year, they were all saying that rates were actually going to be cut. And you did also get a lot of words regarding credibility. So I think the data that we've had since then has been actually slightly softer labour market data. It's been slightly lower inflation data. So we will hear a lot about credibility. So some really quite hawkish language, but still all the usual noise regarding AI, future potential disinflationary impacts of AI. And of course, we want to tighten the balance, shrink the balance sheet, but you'll have to wait for that. I would be surprised if a newly appointed Fed chair steered the committee towards a rate rise in the space of 1 month when the data has provided some comfort, but keep sending the signal. It's not up to us to tell you what our next move will be. We'll look at the data and we're willing to, as our number one credibility factor, meet our inflation mandate, but the implication will be not right now.
So a hawkish hold then is what we're what you're expecting.
Yeah.
So that's the overall expectation. What about the task forces? Is he going to hide behind all of these task forces once again instead of commenting on anything that's particularly tricky? How many times, Janet, are we going to hear there's a task force for that?
You're going to be hearing that for at least the next 3 to 6 months. It really will be. We'll be having these same discussions at every meeting. And, we'll then be thinking about Jackson Hole in August, and then the next dot plot that will not include Chair Walsh's dot for future interest rate expectations in September. So I think September will be the immediate focus. But it will be all these questions regarding inflation. Is it core PCE? Is it trimmed core PCE?
Yeah.
He'll say there's no perfect measure, which is why I've got a task force for that. It's because we need a new inflation framework. And the balance sheet, we need a task force, and then FOMC members will move on it. So, yes, you're going to keep hearing about the task force.
It's funny that the Bank of England borrowed Ben Bernanke and the Fed's borrowing Mervyn King.
Yes, indeed. All of these legends of central banking travelling around a little bit to share their expertise. And moving on to the Bank of England then, and thinking about what we get there. We're used to dissent at the BOE. Maybe it's a little newer at the Fed. Are we going to get quite a lot of dissent at the BOE this week, Janet, or just a little bit?
You're going to get dissent at the FOMC. I think you will get 2, maybe 3 FOMC members voting for a rate rise. And that's what markets will have to latch on, given they've got no forward guidance. For the Bank of England, you will still get a little bit more in the way of forward guidance. I think it's pretty much a done deal. You'll get 2 dissenters, the usuals. Hugh Pill has been the persistent dissenter, potentially Megan Green. It's possible you get a third with Catherine Mann, but I think we're expecting it to be 7-2. And there is an expectation. Certainly a lot of sell-side economists have been saying maybe we get more of a central forecast this time, which over the forecast horizon would actually have inflation a little bit below target in 2 years' time. But again, a hawkish hold. We stand ready because we know that the tensions in the Middle East, if we do not get a full reopening of the Strait of Hormuz, the oil price will grind higher. We've already seen Chinese imports of oil, which have played we saw a dramatic decline in Chinese imports of oil, down about 40% year on year in June. They've already started to come back in terms of July. So there is that real binary outcome. Is oil going to 70, 75, or is oil on its way to 150 if we don't get this reopening?
And that having an impact fiscally as well. A report from NISA this morning saying that the new Prime Minister, Andy Burnham, faces a £24 billion squeeze from UK inflation. When you look at the fiscal situation, do you worry that the new Chancellor, John Healey, isn't going to be able to leave a credible amount of headroom against the fiscal rules, even if they can say, yes, we met them? Is it not going to be enough for markets?
Well, you're right. Markets do want to see a certain amount of headroom. Partly, they want to see more now. And against a backdrop where from recent years we've had a persistent reduction in the amount of fiscal headroom, but because we seem to be living in incredibly volatile times. We have been since COVID with these unpredictable moves. So when you've got this huge amount of volatility and uncertainty, yes, markets need to see more headroom, but also they need to see a plan. And they need to become confident that the difficult political choices are going to be taken regarding reining in spending or raising taxation or some combination of the two.
So you see that as inevitable? Tax rises, spending cuts?
I think, yes, there has to be some combination of the two, and it's no use saying, well, we'll do all of that in year 5 of the fiscal plan by keep saying, well, by 2029, 2030, debt to GDP will be on a declining trend.
Yeah, we typically in the UK expected a lot in the future, haven't we, in terms of that fiscal consolidation. Let me just dip into some micro news to ask you a macro question. And this is BMW, a headline from BMW this morning, then a red headline on the Bloomberg terminal, Janet, saying that BMW is offering severance packages to thousands of its German staff. I mean, this just taps into the underlying weakness of the auto sector. It's a sector that's trying to pivot to all sorts of things, to defence and supplying other parts of the German landscape. I wonder your expectations for the German economy, given we keep hearing from lots of corporates about higher energy prices weighing on European manufacturing and European industrials. But at the same time, the German fiscal engine is now up and spending quite a lot of money on defence and infrastructure. What is the outlook for the German economy, do you think, right now, Janet?
Well, I think the kind of potential growth rate of an economy that has lost quite a lot of competitiveness over the course of the last decade, that has been very dependent on the auto industry in particular, and now they face enormous competition globally, and obviously they're not at the forefront of electric vehicles. They've got those structural headwinds as well as the demographic challenges. So the kind of speed limit for growth without igniting inflation is very low for Germany. Maybe it's 0.5%, if that. So that's your base case. And now we have got the fiscal spending on top of it. So while you may have had the excitement a year or more ago regarding the role of fiscal policy, everything takes a bit longer. We think it will be adding to growth, but exports are not going to be the engine for it. I think world trade growth is going to be a bit weaker. So, yeah, it will be the usual story of a quarter slightly up, a quarter slightly down. We have got a mild technical recession in our outlook for Germany.
OK, Janet, thank you very much. Thanks for joining us. Janet Henry, HSBC's Global Chief Economist, going around the world with us there. Back to the UK, though, on a programming note, the opening trade will have special coverage of the Bank of England's rate decision. Don't miss the BOE decides, 12:30 p.m. That's tomorrow, isn't it, Lizzy?
Oh, come round quick. You'll be kicking me out to stand in the heat wave. But coming up here on the opening trade, a tech sell-off deepens on AI spending fears ahead of Microsoft and Meta's results. So we'll get more on those next. This is Bloomberg.
we're turning the corner. I tell my team we haven't quite finished turning the corner. We've got more work to do, but I am pleased with the progress so far. We're ramping up production across many of our product lines. Markets are very strong. So our backlog is very, very strong. So our story is really focusing on executing that backlog.
That was the Boeing CEO, Kelly Ortberg, there, speaking with Guy at the Farnborough Air Show. And the context this week for the aviation coverage is that the plane maker Boeing was out with results just yesterday, reporting a better-than-expected cash flow in the second quarter on continued strong demand for its aircraft. We're now looking ahead, though, to Airbus earnings due aftermarket today. Let's get a preview of what to expect. Benny Camel joins us, Bloomberg's managing editor for space and aviation. Benny, let's start with the civil side of things. I'd seen some headlines broadly, not Airbus specifically, but broadly around Farnborough, that maybe there hadn't been as many announcements of purchases of aircraft as some had been expecting. What do you expect on the civil side from Airbus?
So it looks like things are looking up, and we heard just now from Kelly Ortberg, who said we are turning the corner, and that is sort of the overarching theme really for the industry. This is an industry that has been through tough times over the past couple of years. COVID obviously was the big cruncher, but then in the post-COVID era we had supply shortages. We've now most recently had the wobbles from the rising fuel prices. That's sort of dampened supply or demand rather, and so all these things combined have led to a slightly problematic picture for Boeing and for Airbus, but to use Kelly Ortberg's words, they are turning the corner, and that's the sort of optimism that we heard from Boeing yesterday during their earnings. As you said, better than expected numbers, and it's also what we expect to hear from Airbus today. They gave a little bit of a teaser last week at the air show where they came out with long-term targets, and those are generally very well received. They think they can double profit, and the biggest part of that will come from the civil side. So Airbus is best known for its planes. They also make helicopters, they make rockets, they make defense material, but really the civil side is what's going to push the performance of this company, and that's what we'll focus on tonight.
Well, how healthy do you think the outlook will be for the defence side, Benny? Because, you know, we talked a lot during Farnborough about the appointment as Chancellor of the ex-Defence Secretary here in the UK. We've talked a lot about defence spending across Europe and tensions rising in the Middle East. Where does that leave Airbus?
Well, one big question that has come up and that was discussed in Farnborough is how much can Europe sort of assert its own sort of dominance, and how can it create a sense of dominance for the region? How can they wean themselves, as it were, off the US? Obviously, the US is an important partner within NATO, but also as a provider of advanced weapons. But Europe is trying to sort of create its own environment for that, and Airbus plays a key role in that. It is one of the biggest defence manufacturers in the region, alongside companies like Rheinmetall here in Germany or BAE in the UK. And we have seen rising demand for defence products, and that is something that will feed through to the bottom line of Airbus. The defence business was traditionally very up and down, more down really than up over the years. Lots of charges, lots of things that didn't go right, and in the last couple of quarters they have sort of found their stride. So again, something that we expect to see in the numbers tonight, a more upbeat picture, particularly on the civil side, but also the defence side certainly helps.
OK, Benny, thank you very much. That's Bloomberg's Benedict Camel there. And stay with Bloomberg for an interview with the Airbus CFO Thomas Turpford later on today.
Let's turn our attention to technology. We'll get a good read, perhaps, on the global tech landscape when two of the Mag 7, Microsoft and Meta, report their latest results later on today. Let's bring in Bloomberg senior strategist Neil Campling, who can get us set up for these big tech events yet to come. Neil, good morning. So what are the expectations around these two businesses? So far, it seems to me the market has not responded well to either higher CapEx or just incredibly large CapEx, based on the example of two, which is, what did we have, Alphabet and SK Hynix.
That's right. And I think the other thing to consider here is that two measures that the investors will demand to see are growth in terms of decent revenue growth to justify CapEx spend. But the other measure that we need to look out for, obviously, is free cash flow. And that's what kind of spooked some investors last week with Alphabet's first ever quarter of negative free cash flow. It's likely that Meta will have negative free cash flow tonight as well in their quarterly results, which may concern investors. And then the other way of scoping this out, of course, is that the CapEx increases that we're seeing. Now, a third of that capex being spent next year is expected to be on memory within that. So where you've got Hynix with its reports today and a six-fold increase in profit, at the same time 50% increase in their own capex. So there's all these different sort of these data points which are necessarily inflationary in the short term and takes a long time to feed through in terms of the guidance for that spend.
Neil, you've also got all these fears about circular funding rearing their head again. We were speaking to the ASM International CEO earlier on about those concerns. Just take a listen to what he had to say.
A semiconductor cycle is the name of the game, and it's something that's very normal. But what's very important is that the fundamentals for AI in the medium and long term are still there. So we're really not concerned from this point of view. And as far as we're concerned, okay, what's happening is that the need for leading edge technology is going to continue unabated for a company like us. It's being driven right now by AI, and it's needed to be driven by AI.
Do you agree with that from Hichem, that the fundamentals for chip stocks are still strong?
Today, yes, but chips are cyclical. And if you're an equipment company, you're not going to see a change in the demand dynamics from your customers for a year or 2 years' time, but those can change. And if we look at historically, if you're looking at these stocks on a price book basis, they are elevated relative to trends. So the fundamentals are strong at the moment. In the meantime, token prices are coming down significantly, which means, and tech should be deflationary by nature in terms of its use over the long term. So to get ubiquity in terms of usage, you have to see pricing coming lower. And at some point in time in the future, visibility will reduce and demand could have issues for the chip equipment companies.
That AI inflation link, we might hear more about that later on from the Fed. Thanks very much, Neil. Bloomberg's Neil Campling. Let's take a closer look at the markets then with the Fed in mind. Skylar Montgomery-Coney joins us from our Markets Live team. Skylar, I will ask you about the Fed then, because it's Fed Day and we haven't talked as much about it because, of course, we've got a lot of earnings to deal with. But the market has been it's been quite exciting, hasn't it, to watch market pricing around a Fed hike, because I think we're suggesting that there's going to be a hold, but there's been 30-40% expectation of a hike this week. I mean, that's not nothing.
Yeah, exactly. It feels like a very binary outcome today in terms of, on the one hand, you have consensus very much saying it'll be a hold. You had a softer inflation print in June that should, in theory, give them some space. And they've been on hold for so long that you'd think that would be a natural progression before you had more data, particularly because in September you get another forecasting round. You have 2 more big data rounds before then to look at. But I think on the other hand, you have market pricing kind of pushing it in the direction of a hike, because there's this idea that Warsh will want to shore up his inflation fighting credibility, that inflation is already 2 times target, and you have a resilient economy. I think today that very much moves pricing in terms of it's a wobble for the dollar, it's lower yields if you have that hike not delivered. If the hike is delivered, it's very problematic for equities. It means a stronger dollar, higher yields. I think longer term, though, it doesn't matter as much, right? We know where the direction of policy goes. It's whether or not that hike comes today. So it's a timing issue, not a direction issue.
Okay, and obviously it comes back to the oil price in large part. You say that the path of least resistance for oil is upwards. Why?
I'm absolutely so puzzled by why we aren't higher now. In terms of last week, we were at $100 a barrel. Now, that came down over the weekend because U.S. and Iran stopped fighting. Overnight, they started again. And the big things that got us there are still in place, in that there's not ships transiting through the Strait of Hormuz. You have worries around energy infrastructure still being targeted. And the big development last week for me was the fact that Saudi facilities were being targeted. And so that didn't even stop over the weekend in terms of some of your big facilities on the east-west pipeline that have a lot of the kind of release valve or helped in terms of mitigating factors for Hormuz closing. That's now under threat. And so I really think even if you just get a continuation of the current pace where reserves have drawn down quite considerably, nothing's going through, the bias is higher oil prices.
Skylar, we're heading towards the end of the month, aren't we? The end of July. Does that, I mean, it's been volatile on the tech story, certainly in Asian markets. And to some degree in US markets as well. We've seen quite a lot of volatility, quite a lot of pullback. Does that get worse as we head towards the end of the month?
Yeah, I think for Korea, we're certainly not in a safe zone yet by any means in terms of, yes, we've fallen 40%, but I wouldn't even classify that as a bear market yet because we're not even oversold, right? If you look at an RSI measure, it's not oversold. Today, we just went through the 200-day moving average. If you look at leveraged ETF exposure, that's kind of undone half of what we had working up into this year. The good news is that the volatility hasn't spread to other markets, and that standard deviation moves in those markets are still pretty contained. If you look at even NASDAQ tech-heavy stocks, I think the bad news is you are seeing more of that leakage into tech in terms of it's a global issue, what you're seeing, in that you have huge capex globally. Whether or not that translates into a return of investment is very much a global issue. You have increased Chinese competition. You have greater cost of capital. And so as we head into earnings this evening, we've seen that tech struggles even on very strong results. And we have big macro events into month end in the Fed and the Bank of Japan, et cetera.
Okay, well, NASDAQ futures just flat to the downside as we leave things. Skylar, thank you very much. Skylar Montgomery combing there from our Bloomberg Markets Live team. That does it for the opening trade. The Pulse is up next. Euro Stoxx 600 currently flat as a pancake. This is Bloomberg.